If you work in infrastructure investment or advisory, you already know the problem. Long-dated cash flows, inflation-linked revenues, availability-based or demand-based payment mechanisms, regulatory asset-based treatment, debt sizing with DSCR and LLCR covenants. Most DCF models treat it like a corporate, which misses the point entirely. This is what a proper infrastructure DCF looks like. Revenue model, regulated asset base, debt schedule size to covenants, project returns, all tied. Let me walk you through it. Every tab is open, every calculation inspectable. Because infrastructure investors and lenders are going to test every assumption in due diligence. The model can't be a black box. One dropdown runs base, upside, downside, traffic scenarios, regulatory, macro. I flip it. And every revenue line, every debt draw, every equity return recalibrates across the concession life. Every assumption on one tab. Revenue drivers, tariff levels, inflation indexation, volume forecasts, availability deductions, opex, capex phasing, debt terms, tax, equity expectations, structured the way an infrastructure project actually is, not like a corporate forecast, because the difference matters, and parameterized per asset type. So the same file works for a toll road, a hospital, a regulated utility, a PPP. The revenue engine. 30 years of projection, quarterly or semi-annual, depending on concession. For availability-based assets, unitary charge with deductions. For demand-based, volume times tariff, inflation indexed. For regulated utilities, revenue building blocks. RAB times regulated WACC plus opex allowance plus depreciation plus tax. Every revenue line traceable to its driver. Every indexation calibrated. If your regulator changes the price control, you change the calibration here, and the model walks through the rest. Capex phasing. Construction, commissioning, ongoing maintenance. Every capex line flows to the RAB for regulated, to book value for non-regulated. RAB row forward. Opening plus indexation plus additions minus depreciation equals closing over the full asset life, which is where regulated revenue gets generated. Debt schedule on the next tab. Senior, mezzanine, sub. Each tranche with its own tenor, margin, amortization. Drawdown tied to construction. Repayment tied to cash flow availability. The free cash flow build. Revenue minus opex equals EBITDA. Minus capex equals CFADs. CFADs is the metric that matters. Debt sized off it. DSCR, CFADs divided by debt service, every period. LLCR, present value of future CFADs divided by debt outstanding, at every inspection point. The Debt Sizing tab lets you iterate. Start from a target DSCR, solve for the maximum debt your cash flows can support. How project finance banks actually size facilities. Returns analysis. Project IRR, equity IRR, NPV at various rates, payback, MIRR. Covenant dashboard. DSCR against minimum. LLCR against minimum. Distribution lockup triggers. If any covenant tightens, the dashboard flags it. Scenario analysis. P50, P90, downside stress, construction delay. Each pre-built, each producing a full returns picture. Two-way sensitivity. Inflation against WACC. Traffic growth against exit multiple. DSCR under combined stress. Live in a lender meeting. The integrity layer. Cash flow reconciles, operating cash minus debt service minus tax equals equity distribution. RAB roll forward ties. Debt balance matches draws minus repayments. If any fails, master cell goes red. Honestly, if you're building an infrastructure DCF from a corporate template, you're going to miss something the first due diligence round picks up. Use this instead. RAB done properly. Covenants built in. Debt sizing that actually works. It's on sfsmodels.com under Infrastructure. Thanks for watching.